everybody. Welcome to the Attract Capital webinar series. Janine here with David Barnett, CEO.
Hi, everybody.
Today we're going to be talking about adjusting your way to a larger loan. What are adjustments, Dave?
Very good question, Janine. So what are adjustments? So we're not talking about cracking your back at the chiropractor. What we're talking about are expenses, adding back expenses to your profitability to have a larger profit or EBITDA line. And it has really a big impact on the size of the loan that you'll get from a lender. And they really are, these adjustments are like one-time, non-recurring expenses that your business might have. It might be where you had excess legal fees in 1 year because you had a big legal issue that you had to deal with. It might be you had a restructuring and you laid off a lot of staff, and so you didn't have those people as part of your company anymore. But they're extraordinary expenses that if you don't add them back, it'll make it look like you made less money or less EBITDA in a given year. And when you're trying to get a loan, it's really important to make sure that the EBITDA or the profitability of the business shows the true underlying strength of the business. So adjustments are really important. They're part of the vocabulary of finance, and you need to understand them and you need to know how to articulate them in a way that a lender will accept them.
Articulating the adjustments. I like that. So how can they be used?
So when you have adjustments, you can take, to use an example, let's say your company's EBITDA is $1 million before adjustments, and you have $1 million worth of adjustments. Now your adjusted EBITDA is $2 million. So if you only have $1 million of EBITDA, you can get a $3 million loan, or 3 times that. If you have $2 million in EBITDA, you can get a $6 million loan. So every dollar of adjustment that is accepted by the lender, you would get a triple play on effectively. So it'll take your loan, if you double your EBITDA, you'll double the size of the loan at a minimum. So it's important that they're legitimate, that they're not harebrained, that they have to be justified. But like we're living through a period right now which is actually a very rich learning experience as to adjustments, because the COVID period, businesses had lower revenue, businesses had extra expenses. So much of this fiscal year for businesses is extraordinary and non-recurring. In fact, for many businesses, almost the entirety of the year is extraordinary and non-recurring. So I think it's looking at your business, understanding what you can explain and what you can defend as a one-time event that somebody on the other side of the table, once you explain your logic, will buy into.
Okay, so then as you're getting into that specifically, what are the keys to adjusting the proper way?
Exactly, and so much of it, back to the word you mentioned, is the articulation and the expression. So you want to be very detailed and organized when you are presenting the add backs. You need to show it on a monthly historical basis. The reason for the add back must be very clear and easy to explain, because the harder it is to explain, the less likely the lender is going to accept that add back. It just sounds like it's a bunch of rigmarole to them. So the more that the explanation is a word salad, the less they're likely to buy into it. And as I mentioned, COVID is a great example, because so much of COVID, whether you had extra expenses for certain types of cleaning materials, whether you had payroll that you had to pay because you had people but you had no business. So there's lots of different ways, lots of different layers to looking at your business and representing it through the COVID period. And they also can't keep repeating. Like a lot of companies say, well, I had a legal expense 3 years ago, and then I had a legal expense 2 years ago, and I had a legal expense last year. It's like, well, if it's recurring, it's not an add back. Add backs can't grow back every year. They have to be out of your business and forever in your rearview mirror. And the thing about add backs, Janine, is that it's really the difference between a loan size working for you or really not working for you. So it's a critical part. And it's something that if you don't understand add backs or adjustments, it's really important to educate yourself on it before you engage with the lender. And it really makes a huge difference if you do it.
Well, sounds like a very clear articulation of adjustments.
It's such a scintillating topic to talk about, but
I
yes.
love it. So if you need clear articulation with adjustments, tune in to Attract Capital, reach out to Dave, and we will see you guys with another webinar soon.
Thank you.